We're seeing internationally a lot more value in Europe and Asia than we're seeing in the US, and particularly in the industrials side of things. We're seeing a very similar Australian market to what we're seeing in the US. The good quality, even half decent businesses that are not in mining or mining services have been really heavily bid up, and we're not finding a lot of value there at all. We're finding some value in the mining and mining services space, but it's a bit of a minefield, as we've seen with the Forge collapse yesterday. So they're the two pockets, I would say, of value that we're finding. Mostly Europe, a little bit of Asia, and then the mining and mining services space in Australia. Overall, though, we think there'll be better opportunities down the track than there are today. So we've, I guess, disclosed a few of the stocks that we own in the mining services space here in Australia. One of them being Macmahon. We've had a good look at Emeco as well. We're really focused on asset values in that space rather than trying to predict whether the mining services sector is going to recover. We're very pessimistic on it, but we think that the share price has been beaten down to a level in some cases where you're buying trucks, earth movers, equipment for 1/3 of the value of that kit on the open market. Now, it's a difficult market out there, so you're not going to grab one of these things and run out and sell it, but if you've got a contract where you can operate this stuff for the next 5 years and you can buy it for 1/3 of the value of the equipment, then you're a pretty good chance of earning a decent economic return here. One of the things we really think that has changed with a business like Macmahon is they've gone from growth mode, where they were making a lot of accounting profits and reinvesting more than that profit back into the business in terms of kit, to an environment where we expect them to make a lot lower profits but throw off a lot more cash flow, because the capex should now be a lot less than depreciation. You've got all this depreciation going through the accounting statement. So your accounting statement is saying to you, you've got 100 of revenue, you've got $70 of depreciation on this equipment, you made a profit of 30. But if we're not buying any new equipment from the point of view of today's owners, we're not signing any new contracts, all of that depreciation should come back to us as cash flow. We get $100 of revenue, we have our operating costs, but we don't actually have to pay cash out for that depreciation. So we think there are select examples in that space where if the management does the right thing and runs the business for cash flow and for shareholder wealth maximisation, rather than trying to think, well, what's next, what do we need to buy, where are we going to get a new contract from, if they really concentrate on cash flow, you'll still make some money even in a very dire scenario.